If you only read the headlines, the AI trade seems stronger than ever. But if you look at what is happening behind the scenes, the narrative has shifted from unlimited growth to crisis management. In the last 10 days, we have witnessed a coordinated panic among the biggest players in the industry. From secret defensive memos to internal code reds, the actions of Nvidia and OpenAI suggest they are preparing for a major shift. At the same time, the real economy, the one that's supposed to be buying all this technology, is flashing recessionary signals that look terrifyingly similar to late 2007. So here's a deep dive investigation into the documents, the data, and the economic reality that suggests that the easy money period is over. So why are they so defensive? As you can see here on my blog, so I will read some of it and then I will give you some additional info, and you can go check it out if you want. I'll put the link in the description below. You can also click on most of the pictures. That will bring you directly to the source, or that will just make it bigger if it's a chart I put up. Nvidia, after their earnings and after the criticism from Burry and other people, they dispatched a 7-page memo to Wall Street to reassure them. It wasn't an official filing, through the SEC. It was just a memo that hasn't the same weight. And basically, they were compelled to explain why they think Burry is wrong. But why would such a big company have to defend themselves against Burry? It doesn't seem like something they should be doing if they were right. And so if you click on the link, you'll get there. And so this is just the first page. And you can see some of the claims from Nvidia and Burry explaining what he thinks about them and so on. So I won't go through all of them, but just to give you an idea of what has been going on. Then the CEO of Nvidia, Jensen Huang, went on the Joe Rogan podcast. And so even though they mostly talked about tech on the podcast, I thought the timing was interesting, because why would you go on a show that's going to be watched by millions of people at that particular time, and talk about how the politicians are saving the AI industry? It seems like he really wants to sell the narrative, so retail doesn't sell potentially before a big storm over the next few weeks or months. At the same time, Nvidia's biggest clients, OpenAI, has just launched a code red, which is kind of funny when you think about it, because Google launched a code red when ChatGPT 3 was released in November 2022. So now it's their turn. And basically, they really want to focus on making ChatGPT better, because right now people are starting to leave because it's not reliable, because it's too agreeable, because it's hallucinating, and many other things, not fast enough. And so also, because Google's model is better, it was cheaper to develop, it's cheaper to run, and it is better on performance. So basically on every single front. Also, coders have been moving to other models like Claude and Grok. So basically, it used to be that AI was equal to ChatGPT, and now it's no longer the case. And this is something you can actually see in Google Trends. As you can see, around September, it peaked, and then it's just been sliding down a bit, which kind of goes with the release of Gemini 3. But it shows you that usually this is supposed to be a really strong time for ChatGPT and AI models, because students who use AI a lot go back to school, and yet this hasn't been the case. Another thing that I found really interesting and kind of shows how they are bleeding money is that, they have been putting ads like this even for paying users. So how bad do you have to be in terms of cash position to try to alienate even the few paying customers you have? This is really bad. And so now let's go on to the Cisco moment. So basically, one of the things that Nvidia discussed in the memo was that they were not Enron, they were not doing fraud. And the main thing that Michael Burry clarified is that he's not accusing them of fraud right now, even though there are some potential issues, but he's really saying that Nvidia is more like Cisco. Cisco was a real company. They were selling real products to real customers. It's just that those customers just thought that the demand was going to be much higher than the reality. And so they were buying capacity for demand that never materialized. And that's why Cisco's clients went bust. Cisco stock fell by 82% within a year and 89% within the 2-3 years. I just wanted to show you how fast it went down, because this might be something that happens to Nvidia, especially because nowadays there are so many more things in the stock market that make drops happen faster. So basically, it's something that's really interesting to see that Nvidia and Cisco have kind of the similar situation right now. And so if Nvidia's clients go bust, and OpenAI could be one of them, you can imagine the impact and the domino effect, basically. The other important thing that was discussed was the depreciation trap. Nvidia was defending itself, saying, "Oh, our GPUs are from a few years ago are still running at full utilization and all that." It seems like deflection. They were just trying to, not talk about accounting and talk about something that most people, like retail investors, would understand that, oh, they are still being used, so maybe it's not that bad. But the point that Burry made, which is a really good point, is that there's a big difference between the economic value and the useful life. And a good example I thought is basically if you buy a 2-year-old GPU from Nvidia, in the AI world, it's like buying a 10 years old laptop today or a 10 years old phone. Like, might still work and you might be okay using it, but it doesn't have the value that you think it does. Maybe for you it has some value, but you wouldn't be able to sell it for nearly close to the price you paid 10 years ago. So that's what they're talking about. And so because of the accounting thing around GPUs that are not properly discounted in the accounting statements, the AI companies might be overstating their profits right now because they're just pushing the amortization over too many years, basically. So that's the idea. And the other thing that's really interesting is that some of the companies in the AI space are using the GPUs as assets to borrow money. And so if you borrow money based on an asset that is not worth what you're saying it's worth, you can imagine the trouble. It's like if you have a car or a house, you go to the bank and you pledge it as collateral to get a loan. Well, if you say to the bank, my house is worth 500K, but it's only worth 200K, you can imagine how the bank is not going to be happy if they discover it. And then the loan will be recalled right away. And you can imagine the domino effect of that kind of thing. So basically, I've seen many people describe it as the equivalent to the 2008 CDO crisis, with all those startups and even bigger companies using their GPUs, as I said, to borrow money to spend more on AI. So it's like the bubble that keeps feeding on itself. So you can read. I won't read the whole thing. And another example that I thought was good was Zoom is a company that's still in business and that is currently doing 100x the amount of revenue that they were doing over here. Yet their stock has never recovered. So you can see how people saying that the AI is great and the company is great doesn't matter. If it's a bubble, it's going to collapse. And right now, Zoom is the perfect example. I mean, 100x the revenues, and yet look at their share price. So just shows you how you can't really rely on the fundamentals to say, oh, Nvidia is never going to fall 80%. It could, and it could happen a lot faster than you think. So now let's talk about the hardware war. So that's basically between the GPUs and TPUs. So for Nvidia to be able to maintain the 70% profit margin that they have right now, they have to remain the only option in town. But the problem is that in the past week, many people have realized that they are probably not going to stay or be the only shop in town for when it comes to compute hardware. And the main thing that came out was Google TPUs. First thing is that when they released Gemini 3, they said that they only trained it on their in-house TPUs. They didn't use any NVIDIA GPUs. So people were like, oh, that's interesting. And then people did more research into it. And so if you click on it, you'll see the details you see here. And I'm not an expert on it, but based on what I looked at, it seems like the Google's TPU are really good in terms of doing AI compute when compared to NVIDIA GPU. So they might be slightly better, but it's like if you have to go to work, you can go in a car that's just a normal car, or you can buy a Ferrari. But in the end, why would you pay 10 times or 20 times more for a Ferrari than the other car if you can only go on a road that does like 50 kilometers per hour or 30 miles per hour? So this is the kind of thing where it's more important the cost per AI query or AI development or AI training than just being marginally the best. And so that's something that I thought that was really interesting. And Amazon also developed their own, I think, TPU as well, at least their own chip. But you see how the AI narrative is shifting. In the past, it would have pushed the stock market at least 5-10% on the news, just like Nvidia and the other companies. But see, I had to put the chart on 5 minutes because otherwise you wouldn't see it. So basically here, the news was announced, it went up a bit, and then it just went back down, and then it just kept going down. So basically you can see how now they can announce deals, they can announce new chips, and it doesn't seem to have the same effect it used to have. And so that's kind of the moment when you can see a trend shift in the psychology of the people in the stock market. Another thing also that was interesting is as soon as there were articles about Meta that will use Google chips instead of only relying on Nvidia, right away Nvidia stock fell by 4%. Used to be that there were headlines about deals that were potentially just PR, but were pushing the stock price up, and now it's the opposite. I've been telling people for the past 2-3 years that eventually there will be other people competing with Nvidia in the space, because you can't remain the only player when you have such big margin. Like, it will just attract people, and they will develop a product, maybe not as good as you, but close enough for much lower cost. This is something we are finally seeing in the space. It took long enough, but we are finally there. So another thing that was announced was the Genesis mission, and it was announced as something like the Manhattan Project for AI. I even heard people describe it as the Apollo project equivalent, like sending people to the moon. And really, so far, based on what I've seen, based on what I've learned, there's nothing much to it. It's underwhelming. There's no massive infrastructure is going to be built, no new funding. Basically, it's a reorg to connect the national labs and the supercomputer to catch up with what China and Europe is already doing. So, they might announce new things in the future, but right now, it's kind of sad that they announce it as such a big potential project. So I think it's not going to be a liquidity bailout that the market was kind of hoping for. Something else that's kind of related to the AI cost, in a way that I think most people don't realize, and I think this diagram is a good example of it. Most people don't understand that AI is not like software, because they see the big companies that usually do software, and so they think, oh, AI is just an extension of it. But no, software, the marginal cost to sell is almost zero once you have developed something. There's a cost to each query. Queries for like pictures or movies or whatever, that the cost is exponential. And so I've actually found a chart where it shows that basically just a regular ChatGPT query is about 500 times more expensive than a regular Google search. So you can imagine how bad it is and why they are bleeding money so bad, and why they are trying to make deals and invest between each other to try to keep the bubble going. And even if there wasn't this problem, I think most people understand that even though the tech is improving fast, the real demand, and by real, I mean the people willing to pay for it, has not materialized. Because right now, it feels like basically when they say we have 800 million users for ChatGPT, well, it's easy to have users if you're selling a $20 bill for $1. Basically, that's what they're doing. They're giving people access to something that should be costing a lot of money and for free. No wonder you have so many users. So does everybody else. But eventually, they will have to have a return on investment. Otherwise, they will just collapse on themselves. Something else that I found interesting was there was an MIT report that said that basically they looked at the AI pilot project in companies, and 95% of them are failing. And so it seems like AI has a lot of potential, but it's not ready yet. And so right now, most people are just like, okay, this is a nice to have eventually, but I haven't seen a real use case for, it works 100% of the time, every time, and this is replacing this many people. The only space where maybe it works not so bad is potentially with some AI chatbots, although the one I personally used are always terrible. And I always use talk to a human. So, that should tell you something about how good they are. Something else also related to the funding is that even in the best case scenario, so HSBC did an estimate for OpenAI, they won't be profitable even in 2030. Even if OpenAI remains the player there right now, the market share there right now, and they are able to convert twice the number, the rate, the percentage of people they have on the paid plan, so from 5% to 10% of users, they would still not be profitable. So, it really doesn't look good. Personally, I'm not even sure they will be there in a year from now, but we'll see. Something that's also interesting. So look at the AI CAPEX of the past few years. Like basically, last year is almost, the more than all the 10 years before that. And what I found interesting about this one too is look, most of it, probably like 80 to 90%, is either planned or stalled. So basically, if for one reason or another, they stop building those, you can imagine the collapse of this AI CAPEX will just crush the economy and would be a domino effect where everybody would just try to take the money at the same time. Basically, the equivalent of a bank run on AI stocks. So that's something I'll be monitoring, but if there's one thing I'm sure is that there won't be that many data center built, because I've seen so many news about empty data centers waiting for power. So basically it's a warehouse right now and there's no power. So even if they wanted, they can't. So why would they build more when the existing one are not being used and don't have enough power? Just doesn't make sense. And so now we get to the economic disconnect, because it's all good about this AI stuff, but if the economy doesn't work, how are gonna people be able to afford anything, including the plans for the AI models that eventually those companies want to sell you? And so here I wanted to show you first a quick graph showing the massive discrepancy between XPX and the stock market without the AI companies. And you can see that without the AI companies, basically the growth per year has been around 8%, which is typical for the past 20, 30 years. With the AI companies, climbed to 20%. If you only take the AI companies, I don't even remember, but it's like 40 to 60% per year. But also something that is kind of interesting is looking at the retail sales. So in nominal terms, they keep telling you, oh, it's going up, it's going up. Of course, it's going up. The inflation has been insane. Plus, you have more people, so you had the two, and then of course it's going to go up. But if you look on the real basis, it's been basically flat for the past 3-4 years. So look, in the past it was always going up. Even during bad times, it was kind of flatlining a bit, but then it would move up. Here, it's been mostly flat for the 3-4 years. So that's kind of insane. And when you look in volume, it's been negative. So that tells you how the headlines are not telling you the truth. And so if you want to click here on the picture, you'll get to the article of CNN Business. So they dive into the Salesforce data. And as I was telling you, the volume is down, transaction is down, and spending is up because of the inflation, which was actually calculated as 7% for the goods that were purchased. So you see how the official inflation is only like around 3%. Well, the stuff people are buying was up 7% here. So if you discount it by the real inflation for the GDP would be negative, even with all the AI CAPEX. Also, another thing that really shows you that it's not a strong economy, people are buying more and more stuff on a buy now, pay later plan. So most people are really living on borrowed time. And the job market just keeps getting worse. So we won't have the official data from the Bureau of Labor Statistics because the government shut down. And then when they reopen, they said, oh, we need more time. So it will be delayed after the FOMC next week. But in the meantime, we have some data from the private sector. So the ADP job report has been publishing weekly data for about a month. And this was about the monthly report for November. I know it was a shocker because if you look at what they were expecting growth, so plus 10,000 job created, and the result was actually minus 32,000. So right there, it's like the analysts that were supposed to be having access to a lot of data we don't. They thought it was going to be growth. It was bad. But the real story was, if you look at the change by business size, basically you can see that the businesses under 49 employees, they were bleeding badly. They lost 120,000 jobs. And it's really important because usually they are the bellwether for the economy. They make 30% of the total employment. And historically, they are the one that will react the fastest when the economy changes for the better or for the worst. And so when they are just laying off massively like this is a really bad sign. I'll show you later on a chart with the ADP on it that looks almost exactly like 2007. So that's pretty bad. Another data point was the Challenger report. So same thing, if you click here, you'll get to that page here. So you can check for yourself the data if you want and all the stats. But basically what I wanted to highlight is that they were basically saying, the headlines have been, month over month, it's been declining. So this is good. And if you look at the chart, this is the decline I'm talking about. This is not like a 1 month of up or down. Like, this is a very volatile thing. Is not the most important thing. The most important thing is what's actually happening. And what's happening is that November cuts are up 24%, versus the same month last year. Usually November is a month where you don't see a lot of firing because it's before the holidays. I think that's really important is that year to date, it's up 54% versus the same period last year. So you see how the headline might be saying, the pace of cut is slowing down. But really, when you look at the stat for the year to date for this year versus last year, and for November this year versus November last year, it's getting worse. It's not getting better. And so that's why I wanted to let you know that if you look at headlines or charts like I just showed you, it might be misleading. So here's the real stat. And also the 54%, it's the highest level since the 2020 recession. So you see how bad it was in 2020 for job cuts when people thought it was the end of the world. Well, basically right now it's at the same level. And the other thing that was in this report was the hiring. Hiring is also dropping to the lowest level, not since 2020, since 2010. And the seasonal hiring is at an all-time low since the data has been tracked since 2012. This is really bad. This is not the kind of thing people and companies do when the economy is okay or in between. They do it when the economy is rolling over hard. And so they are preparing for a recession, which, if you've been watching me and my video, I've been saying most people have been feeling it since 2022 because their purchasing power and their life have just been harder and harder since then. Eventually, it will catch up. And actually, that's my next point. If you look at the parallels between 2007 and right now, it's very similar. So basically, US stocks peaked in October 2007, and the economy entered recession in December 2007. It was only declared a year later because they are always late, but everybody knew that the recession was going on. And if you look today, well, the S&P so far has also peaked in October, and the job creation has been taking a really big nosedive in the past few months. I mean, the government even postponed the data for jobs potentially because they knew it was really bad and they wanted to, help the stock market and the AI bubble that was kind of showing cracks. But yeah, basically, if you look at this chart again, you can click on it to get the full picture on the source here. But you can see how the ADP private report, it's a 10-month moving average to smooth it out a bit. It took a nosedive here, and it's taking a nosedive here. And so what will happen next? We'll see, but basically it's not looking good. So just to finish quickly, here is, I wanted to give you a bit of information of what I've seen the smart money doing. So basically, they've been positioning for a few weeks. I told you that they've been selling to retail investors, and they did a classic rotation from growth at any cost to really protecting their capital, because the big players, that's the main thing they want to do, preserve the capital, especially raise cash so they can buy when it will get cheap eventually. And so what they usually do is a barbell strategy. So basically they avoid the middle. So they avoid those risky company that have high debt, high valuations, and no path for monetization. Think OpenAI. I know it's not in the stock market, but just to give you an idea of the type of company that they are trying to avoid. And the infrastructure trades, all the AI chips seems to be a bit crowded. So that's something they are avoiding. Of course, they are rotating into the value and the boring sectors because those might be using AI to improve a bit the efficiencies, around the business. Those companies are more likely to survive the crash eventually. And also they are using hard assets to, get ready against the money devaluation that will likely be required with huge money printing through the central bank, but with the request of the government that will create all the programs and the fiscal stimulus likely to try to save the economy, especially a year ahead of the midterms in the US. Basically, it's what I've seen. So I don't know if this will help you, but it's just something to keep in mind, because the main point I wanted to end this analysis on is I've seen too many people think they are genius because they just bought anything since 2023, and the buy and hold and buy the dip has worked so far. But it's not always going to work, and the day it's not going to work is the kind of day or weeks or months where some stocks will lose 80% or 90% like Zoom, and they will just never recover, maybe for decades or more. Japan took 35 years just to get the money back, not even with inflation. So this is a good time to think about your portfolio and to think not in terms of what you can win or earn, but how much are you really willing to lose. And if you're not willing to lose a lot of money, maybe thinking about ways to protect your portfolio. So I hope this helps. If you have any questions, leave them below, and I'll see you on the next one.